So let's begin with what a balance sheet looks like. And I split up a balance sheet, a sample balance sheet here into two categories. We begin here with some very common elements that you'll see on the first half of the balance sheet. This is where you'll have a tabulation of your cash, your accounts receivables, your inventories, your gross fixed assets, depreciation, which lead to your net fixed assets, and then at the bottom you total up your total assets. Let's go through these one by one just to talk about what they are. So the idea behind cash is that it's liquid and it's easily accessible and it's in a bank account or in a physical allocation where the cash may exist. The reason I say that it may in a physical allocation is that in one of our businesses we got so sophisticated about our cash management that we had a separate account that monitored the transfer of cash between our bank account and the end location for the store that it was likely to be delivered in. That was a cash account in itself. And so if there was money in transit, that had its own representation in the system that needed to be reconciled and accounted for on a regular basis. So it's not just places of physical storage of cash, but also mental and architectural designs for where those cash allocations may reside if they're in a bank account or if they're in physical space. Accounts receivable, that again represents money that your customers owe you that you have not yet collected. So these are sales that have been booked and that have occurred, but they're the outstanding balances in a cumulative form that your customers continue to owe you. Your inventories are supplies or products or components that you have purchased for the purpose of reselling. So these are the things that you have to sell to other people, to your customers, to create revenue. But in some cases you must first have it to actually turn around and sell it. So this is where the value of your products that you are assembling or compiling to sell to your customers, this is where it gets valued and reported. One of the words that we use in accounting is the word current. Current stands for 12 months or less. So when you see the word current around where it says current assets, it just simply means that these are assets that are expected to liquidate in 12 months or less. Another term for current is also short term, meaning 12 months or less. And the opposite of short term or current is long term, which means 12 months or 1 year or more. So when you see the word current, it indicates that the asset liquidity is supposed to be 12 months or less. When you see the word long term, it usually means 12 months or more. Gross fixed assets means physical equipment that you have. These things can be things like vans, buildings, they can be large pieces of equipment, they can be very large pieces of furniture. These are very large assets that you acquire over time to help run your business. And they are expected to last you significant amounts of time so that your business can run through the use of these particular types of assets. Now, if you remember, we talked about in the profit and loss section, we talked about depreciation and the fact that you reduce the IRS gives you the ability to reduce the value of your equipment over time. Well, as your equipment loses value over time and you track that loss, you have depreciation being tracked on the balance sheet to show what the net value is of your asset at any particular point in time, with the gross value that should be what you acquired it for minus whatever the value has been that is lost over the period of time. The two together, the gross fixed assets minus depreciation, equal your net fixed assets. You also have another category that we did not put into the example here, which are other assets or other current assets, which may be other things that don't fall into either the current asset category or into the fixed asset category that may be reflected. And when you're done totaling all of those different types of assets on your balance sheet, you have a total asset count. And in this case, you have $100 in cash, your customers owe you $8,000, you have $6,000 in inventory, which give you a current asset of a value of $14,100. In this case, you have a $5,000 piece of equipment that has been devalued by $100 over the period of time. When we did this report, which gives you a net fixed asset amount of about $4,900, and those two numbers together total up to $19,000 in assets. Compare that against the liabilities and equity section of the balance sheet, which is below usually, in which we now tally up the things that you owe, the components that you owe, and then and we also have a value assigned to the net worth of your business. So in this case, accounts payable is defined as the money that you owe to your vendors or to the people who have sent you bills that you have not yet paid. And other current liabilities, again, the word current simply means other liabilities that might exist that you have outstanding that are expected to liquidate in 12 months or less. In this case, other current liabilities can include things like sales tax payable. So you may be in a business where you collect sales tax for the transactions of your customers. You've collected it over a period of time, but you've not yet paid it out to the government entity that it's owed to. You might have other current liabilities, which may include things like federal income tax payable. So if you have payables that you collect on your employees that you have not yet paid, and there may be a number of other types of current liabilities that may exist that are in that realm. So short-term liabilities that you're accruing or that you somehow owe that are expected to liquidate in 12 months or less. On the same level, you may also have short-term loans, which means these again, short-term again means 12 months or less, the same meaning as current. If you have a short-term loan, this could be something on the order of a loan that's expected to pay off in less than a year. And credit cards also come into the current liabilities category. In QuickBooks and other software like that, they have their own account, and in many cases you see a credit card type of account as opposed to a strict other current liabilities account, but it's there and it's in the same category. So the idea, credit card, short-term loans, and other current liabilities and account payables are all considered current liabilities. So when you tally up all of those different components, you get a total current liabilities, and in this case it's $14,000. Next, we talk about long-term loans. Long-term loans, again, are loans that are expected to pay off in more than a year. So these will include things like mortgages, vehicle loans, equipment loans that span several years, etc. That's the balance of what you owe going into that category. And in this case, we have owner's equity, which can include a number of things. Owner's equity can include retained earnings, which is a reporting of the undistributed profit of the company over the period of time, or rather the profit, the sustained or the accumulated profit of the company over a sustained period of time. It can include capital investment. So if you gave the business money, or if you invested money in the business personally as an owner to get the business going or to float the business, or if investors came in and put money into your business in the form of an investment, these are also different components of equity, and we'll discuss more about those as we get further into the section. Now you'll notice that the total liabilities and equity also total to $19,000, and this brings us to an important point. The reason we call the balance sheet is because it's a very obvious word in that the balance sheet must balance.